Today we're going to go over some basics of investing in stocks. So first we're going to go over some of the key indicators or words or whatever you want to call them. They're right here on this platform that I'm using, but you'll see them usually right after a stock once you click on it. So I guess we'll just go right into it. First we have volume. Volume pretty much just means the amount of shares that were traded in a given day, and then right below here, average volume. Obviously, that's just the average traded every day. And then we're moving over to beta. So a beta means pretty much if it's above 1, it's more volatile than the market as a whole. So that means it is more likely to move than the market. So in this case, Apple 1.17, that's going to be a little bit above, more movement than the market as a whole. And if it was below that, it would be more stable. Market cap, that just means the value of the company overall. You hear people refer this to saying like Amazon is worth this much money. That's the market cap, what people are talking about. In this case, Apple is worth almost $1.7 trillion. I mean, this is the biggest company out there, I believe, right now. So usually it's not going to be this high, obviously. Then we have PE, which stands for price to earning, which is the amount an investor can expect to invest in a company in order to receive $1 of the company's earnings. So in this case of Apple, you would have to invest $30 to receive $1 of the company's earning. It's pretty, I just looked at that definition online to show you. I honestly, personally do not look at PE ratio or the next one also, EPS, to choose the stocks that I invest in. So yeah, we'll go into EPS, which stands for earnings per share, and that's just the company's profit divided by outstanding shares. And I don't want to deter anybody from looking at these because they are very helpful indicators. I've just found personally, I don't really understand it. I didn't really look into it that much. I prefer looking at graphs and technicals and past trends to choose where I would invest in. And then the last indicator I'll be going over is yield. Some people call it dividend yield. It's pretty much just the amount that you can receive back in dividends annually. So most companies issue their dividends in quarters. So you could, after you calculate how much your dividend yield is going to be for the year, you could divide that by 4, and that's what you can expect per quarter to get back in dividends. Also, I want to mention bid and ask. The bid is how many, there's going to be a size, so that size 1 times 100 in TD Ameritrade's case. 100 people are bidding $388.20 for Apple right now, and also at the same time, 500 people are asking to sell their shares at $388.40. This is the aftermarket, so normally that number will be a lot higher. And also some platforms do already multiply the bid and ask size by 100. Usually it should say it somewhere. I don't really use other brokers that do that. Next, I want to go into the hours of the market and when you could buy or sell. So currently it is 10 p.m. Eastern time for me, so the market is closed. It is the aftermarket. The normal market hours for Eastern Standard Time is 9:30 a.m. to 4 p.m. But there is, like I mentioned, an aftermarket and a pre-market. Those are times where you could trade on some platforms. Some platforms don't allow that, and some platforms let you trade for longer in the pre-market, or earlier in the pre-market and longer in the aftermarket. And during those times, you can still buy and sell, have all the same functionalities, except there's a noticeable change in investors. So you're going to have a lot less volatility, which means there's a lot less people trading, which means market orders will have more of a range where they can execute at. I wouldn't recommend doing a market order during a pre-market or after hours, just because it could execute for something much lower than you're trying to sell it for, or much higher than you're trying to buy it for, because there's not that many orders being placed at that time. Market order, if you didn't know, is pretty much a buy or sell that will be executed immediately for the current price. So if there is no sellers and you're trying to buy a stock, if there's no sellers selling it for around the price of the stock, so in this case 388 for Apple, maybe there's one person who has an order out there for 400, it's going to execute for that if they're the lowest price available. So it could, in Apple's case, I don't think you'll run into that, but for smaller stocks, you probably will run into something like that. So that's just something to be aware of. You also have a limit order, which is what I would recommend if you do trading in the pre or after market, or during the regular market hours too. If you are doing a large order, extra cents on each trade can save you a lot of money, or make you a lot of money if you're selling. Pretty much you, instead of selling immediately, at any price, it's going to put the order in at a designated price that you choose and execute when it hits that price, if it hits that price. So definitely, if you're trying to get every cent out of your sale, you want to use a limit order, or on the other side, if you want to buy the lowest price, which I don't see why you wouldn't, you would do a limit order. But if some people are long-term investing, you don't really have to look into doing a limit order. Mentioned that there are other orders aside from a market and limit order, such as a stop loss or a trailing stop loss. But that's nothing that a beginning investor should be looking into right now. I think stop loss would definitely be the next thing to look into, but for this video purposes only, we won't be talking about that. But in a later video, I'll go over the different types of orders there are, because there are quite a few and even more than I just previously mentioned.